Ladies and gentlemen, welcome to this special interview. Today we have a returning guest to the show, Steve St. Angelo of SRS Rocco Report, located at srsroccoreport.com. And I got to tell you, a lot of people like to talk about gold and silver, but they miss one serious factor when they're talking about it, and that's energy in the oil industry and the energy sector. And there's nobody who can better fuse these two issues together like Steve St. Angelo can. So we're going to pick his brain today and talk about why energy and precious metals working hand in hand are so important together. Steve, I'd like to thank you for returning again to Silver Doctors.
Paul, thanks for inviting me. There's a lot of interesting things going on in the market today, so there's no shortage of subjects to talk about.
That's true. There are a lot of important things going on in the market, and just starting off with energy, Steve. One of the ways people can think about silver is stored energy, and it takes a lot of energy to get silver out of the ground. You got to break up the earth, you got to separate it, you got to cast it into bars, then you've got to refine it, then you got to stamp it. So the concept of silver and gold being stored energy is in fact a thing. And I was just wondering, like, what does energy mean to you, and why is energy important to gold and silver investors? And am I thinking about that right when I think about silver as stored energy? In any direction you'd like to take that first question there, Steve?
No, I agree. The only thing I would change, Paul, is gold and silver are stores of energy equivalent value. Because if you look at the global economy or the US economy, people are buying goods and services, they're going out to eat, they're buying RVs, they're buying a new home, they go to Walmart and buy new clothes or whatever. But even though we're trading goods and services, the overwhelming factor in the price of those goods, let's say the goods, it's the energy in all forms and all stages. So when you break it down, all the construction of all those, the manufacturing of all those goods, the whole supply chain, the transportation cost, the energy that it takes to run the Walmart, the energy that it takes people to drive their cars to Walmart, the trucks that deliver all these products. So when you take it to its basic denominator, the price of that good is the energy. So really, if it's like the movie The Matrix, the guy was looking at the screen and it was all this code, but he sees a picture. So when you understand that the energy is the picture, basically all we do in this economy is trade energy, not buying gasoline or electricity for your home, but the goods are basically nothing more than energy transfers. So that's all the economy is really, is trading energy in one form or another. So when you understand that money has been a store of this energy equivalent value, ever since the ancient Greeks and Romans and Phoenicians were mining gold and silver, it hasn't changed in 2,000 years. It's still the same. And so this is the analysis I try to put forth, because this oil that's come on in the last 100+ years, it has given us a tremendous amount of energy and productivity. A typical machine today does the equivalent value of 200 humans, labor, machines. And that's all run by oil, natural gas, and coal. And so it's been that tremendous productivity from energy that has allowed us to do all these wonderful things with technology. Now, this is the issue. The problem is energy is becoming problematic, Paul. And what happens when energy becomes problematic? Fiat money and all the assets that are based upon energy in the future are problematic. Gold and silver are based upon energy burned in the past. So that's why they are banks of money, and it hasn't changed in 2,000 years.
Mm-hmm. And that's very interesting that you say it's energy from the past, because I'm thinking of what the Fed and the federal government are doing with their fiscal and the monetary policies, and all of this spending that's being created. That hasn't been created. That's just kind of like double clicked, as Powell said. They just print it digitally, as he said a couple weeks ago in an interview. So why is it that gold and silver are stored energy, but like dollars aren't energy at all? They're debt based. Is that a good way to think about that, or am I making sense there, Steve?
No, you are. And the thing is, I don't mean to correct, but it's there is no energy in a gold coin, but there is energy equivalent value. It takes 80 times or more the amount of energy to produce an ounce of gold than an ounce of silver. That's just the physics. That's the engineering. That's the reason why, in an interesting way, that right now the gold and silver ratio is this 80-1 plus or minus. It's been fluctuating, but it just takes so much more energy to produce gold and silver. That wasn't the case years ago when we were mining very high quality, very dense veins. It wasn't that high. There wasn't that much. There was not much, maybe a 10 to 15 times more energy. Now it's 80 times because we're mining gold dust, 1 gram per ton. So the difference is, if you take a gold coin, it costs about $1,200 to $1,300 to produce it. A gold coin, 1 ounce. If you take 12 $100 bills, the Treasury, it cost about $1.80 to print those $100 bills, which is also $1,200. So when gold used to be money and it was a gold coin, or you had a gold certificate, it was actually backed by that gold. So the issue is, a Federal Reserve note is an obligation, right? If you have a house note, a car note, you owe it. So all these things we have in our pocket that we use for money, it's not real money. It's not a gold certificate. It's not a silver certificate. It is a note. So basically, we're trading for money, all these obligations, and people don't really understand that. And it's fine when energy production continues to increase. You can stay on that. But when it peaks and declines, all that unravels, Paul. And that's where we're right there now. We're right at this, I call it the energy cliff, which is why it's so important to own the precious metals.
Now, Steve, this makes me think about the fact that, over the past couple years, it seems like we've been hearing a lot of things coming out saying, well, the U.S. is energy independent now. The U.S. is energy independent. And to me, it sounds like, thinking about it from an energy perspective, that, well, we're able to sustain our lifestyles because we can freely produce the energy that we need to have a society. But is the U.S. actually energy independent? Can the U.S. be energy dependent, or what is coming for the U.S. oil industry, Steve?
Well, I've got some charts I haven't put out yet, but I will be publishing on my website. The U.S., if we look at crude oil, condensate, natural gas liquids, and other oil, the U.S. since 2007 has increased their total liquid petroleum production 12 million barrels a day. Now, let's compare that to the rest of the world, 4.4 million barrels. The U.S. added 75% of global growth. So we kind of propped up the global economy with this energy growth. You can't have global GDP growth unless you have oil production growth. They go hand in hand. So the U.S., the shale industry, has been responsible for adding all this oil. And I didn't think it would get this high, but we've added all this oil and all these other petroleum liquids, which accounted for 75% of global GDP oil growth. The problem is these companies in the Bakken, the Eagle Ford, the Niobrara in Colorado, and the Permian, but the first three, they have already gone through 80 to 90% of their drilling acreage. So unless the Federal Reserve can print more land and print more drilling acreage, the shale production was going to peak and decline regardless. You can only suck so much of this oil out. And again, they've already gone through a large percentage of their core area. And so now with this global contagion, it sped the process up. So when oil production starts to decline in the United States, if it accounted for 75% of the total global growth, it's going to pull down the global economy. Just on that metric alone, and that's going to be very problematic for fiat currencies and the assets of most stocks and bonds.
Mm-hmm. And, a couple of months ago in March, I can't remember the exact day it was, but there was that one day when the crude oil futures went to like negative $40. What are we to make of that crazy action in the markets versus reality? Do you have any comments, or what were you thinking the day that happened, Steve?
Well, we can talk about the comics, right? And the CME, and all the crazy futures. And it seemed as if a lot of traders came in kind of like the the Robin Hood traders came in Hertz. They came in at the wrong time, and I think what happened was they could not roll over these contracts for Cushing, and so they had to eat them. They had to buy them back, and that just kept dropping the price. And so it was a one-off deal. I think we're going to see lower oil prices though, but that was kind of a one-off deal due to the futures markets and due to I would say, a large percentage of unsophisticated traders getting in where they didn't really understand what they were doing. But let me just tell you how bad the situation is. The largest oil company in the United States is ExxonMobil. It was the old Standard Oil. It's been around for almost 150 years. Back in 2005, when the price of oil was the same as it was last year, the same price, just about, they're about $56, $55 a barrel. ExxonMobil made $6.2 billion in its U.S. oil and gas wells. Last year, it made $536 million. And guess what? It spent $11.6 billion on capital expenditures for its oil and gas wells compared to only $2.1 billion in 2005. You see, it's going in the wrong direction. So those figures, they don't lie. They show you that even Exxon, which is the largest oil company in the U.S., is hemorrhaging. It can't make money, even at $55 a barrel. It's spending so much money and it's not really making money. And that's the problem with the falling energy return on investment of oil. So that's where we are right now. And I believe, Paul, when U.S. oil production really starts to decline, I think we're going to see serious issues. It's like Venezuela. If you can print money and bring on oil production like we did, in the Fed printed money since 2008, and we added all this shale production, you can print money and get away with it. But Venezuela printed money and they lost oil production. And what happened? They went into hyperinflation. That's kind of where we're headed.
Mm-hmm. And that's very interesting. That brings up a lot of interesting points there. One of the things that just comes to mind immediately is, production is declining, but in the case of Exxon's scenario, it's almost like, well, we're going to make it up on volume, but you can't make it up on volume because production is declining. So now this decline in production, I guess you could say it's actually good for a couple of reasons, because it's actually just the markets finally coming back and reasserting themselves. Because if we can say that, the crude oil industry in the United States has been propped up by debt and by financing and by money printing, then the decline in the production is just trying to get things back towards their natural balance, as opposed to just feeding it with the debt. Am I thinking about that correct there, Steve?
Yes, you are. However, if the U.S., the GDP in the United States, I'm trying to think of the number, was it 25 trillion? I'm trying to think. That's based on the energy consumption. So if you have less energy consumption, then you're going to have lower GDP. You can't have a higher GDP unless you have higher energy consumption. And we still import a lot of oil, and that's the problem. So when you look at the global economy, the only way the global economy can grow is if we bring on more oil. And I think I think 2019 was going to be the peak in global oil production. Mm-hmm. And so what does that mean? That means a typical Ponzi scheme, you need new investors. Every year you need a new investor to help pay back the old. Well, we have all these people who are going to retire, who have 401ks and pension plans. Well, how do they get their money? They get their money from economic growth and from new investors. Well, if you don't have that growth, how do you pay them back? So the whole thing starts to fall apart, and you don't need a major collapse in energy production. All you need is you don't have any more new investors in the Ponzi scheme. You don't have the growth.
And so at the same time, you have the falling energy supply and energy production translating to falling GDP. You have rising debt at the same time. So it just throws those ratios even more out of whack. Now, Steve,
exactly.
Shifting here to silver, you wrote a very interesting article with some really eye-popping charts yesterday. talking about the collapse in mine production from Chile or Peru. Peru. I'm sorry, Peru. So I guess my two questions are: what does this collapse in silver mine production in April mean? What is Peru significant for? You think that Mexico is going to be worse, and why should silver investors, and frankly any investor for that matter, be concerned about this issue, Steve?
Well, basically, physical supply and demand haven't impacted the paper price of silver. However, that will occur in the future. It's been the paper price of silver, whether it's ETF demand, which are retail investors, or investors on the comics, that's what's pushed up the price of silver or down for whatever reason. However, it will become physical demand. It will become real supply and demand. And I believe it's starting to change now. Now, Peru is the second largest silver producer in the world, right behind Mexico. And when you see that 74% of their production fell in April, I mean, you've got to go back decades to get that low. And then I believe May is going to be just as low because they didn't start bringing on their mines until the end of May. Now, Mexico is the largest. I think they produced a third more than Peru. I think we're going to see even larger numbers from Mexico when they release towards the end of this month. So Mexico is going to show declines, big declines for April and May. And then what's even worse, Paul, I think the global economy is really going to get into another big slowdown. As all these problems really start to snowball, and then the economy is going to suffer even more in the second half of 2020 and into 2021, which means we're going to need less base metals, less economic activity. We're not going to need as much copper, zinc, and lead. And that's where 55% of silver production comes from, a byproduct of copper, zinc, and lead. So that's the first whammy, is the shutdown of economies and the shutdown of silver supply, while at the same time we're having massive increase in physical investment. Yes, we are seeing a slowdown in industrial applications, industrial usage, but I do believe physical investment is going to totally overwhelm the market in time. And it's not going to, industrial demand won't matter. And so I think the next phase is when these mines start coming back on. I think the next big issue with supply is going to be a decline from base metal mining byproduct silver. And that's just going to make the situation even worse for supply.
Mm-hmm. That's very interesting because, people say there's no such thing as a supply shortage and you guys are just pumpers, and we hear that all the time. But if you look at the actual hard data, yes, mine supply has collapsed, as you have clearly shown, which brings me to another question here. So, Steve, in addition to the collapsing mine supply that we've seen in April and potentially more collapsing mine supply that we're going to see in May, you recently wrote an article talking about 5 billion ounces of silver have been lost possibly forever. So could you just kind of explain how are these ounces lost? There's actually more gold in the world than silver. And what does this mean for the investor, Steve?
Well, according to my analysis, there's about the same amount of identifiable above ground investment silver stocks as there's gold. I think it's 2.5 billion ounces of gold. That's private and central bank, and that's bars and coins. And then there's also about 2.6 billion ounces of silver bar and coin. Now, there might be more held privately, but there you go. It's about a 1-to-1. We can even double it and say there's 5 billion ounces of silver. So, but there's still not that much more silver. Now, there's been some analysts that say there's a lot of above ground silver because they've mined 52 or 55 billion ounces of silver since the early 1500s. Well, most of that silver has been used in industry, or it's used in jewelry. Well, people buy silver jewelry, they'll spend $70, $80, $100 on it. But in matter of fact, most of that, there's not that much silver in it. So if they go to pawn it, they're going to get $10, $15, $25, $30. You go to a pawn shop with a nice gold ring, you're going to get $750, $1,000 if it's a large ring. So it's worth your effort to pawn the gold jewelry. It's a waste of time. And let me tell you, people throw out their silver jewelry. They don't like it anymore. It's and so not only is all this silver used in industrial applications, it's in the switches, in the light switches in your house. When that house gets demolished, it goes into a landfill. All the electronics, most of the electronics that have been made, that go into landfills. Very little bit of the very small amount of industrial silver is recycled. There's other industrial silver that's recycled. So I estimate over the last about 10 years, 5 billion of the 8.3 billion ounces that were mined, that's likely lost. It's economically lost. It's just not going to be refined or recycled. And we have to go back to 2011 when silver hit $50 an ounce. There was only about 230, 250 million ounces recycled. That's it. Mm-hmm. So even if the price of silver surges, I don't see a lot of people even recycling silver. Not like gold. 90% of gold recycling comes from jewelry. Only 12% of silver recycling comes from silver jewelry. And sometimes there's more silver jewelry sold in a year than there's investment silver, 200 million ounces. That is basically lost forever.
Mm-hmm. And it's very interesting because, I'm also thinking about the energy dynamic to the recycling. And, if it's a, ring or something like that, that's one thing. But if you're trying to recover silver from like electronics and things like that, well, that probably takes a heck of a lot of energy to recover that silver. And in addition, it takes a lot of harsh chemicals to be able to separate the different elements. So is that another dynamic that could be coming into play for the scrap recycling as well, Steve?
Yes, that's correct. When you take a gold ring in and it gets recycled, there's some other metals in there, but it's a much lower energy footprint. When you start grabbing all these iPhones and computers and electronics, they call it e-waste, and then you've got to collect all this. There's a lot of plastic. It has to be, yes, it's very energy intensive. So it's not as economical to recycle that kind of, to get the pressure, even platinum or some of these other rare earths. So yes, that's why silver, they call it the industrial metal. There's a lot of analysts that say silver is not a good investment. It's not really money. It's more industrial metal. Well, because it's been an industrial metal is the very reason why I believe silver is a much better investment in percentage terms in the future than gold, because most of it is lost. And so when people actually try to protect wealth in real assets like gold and silver, not U.S. treasuries, not highly inflated stocks, or even real estate, they're going to find out there's not that much silver. And that to me is going to be, I call it the precious metal. They're going to get precious metal religion. And that is coming, Paul, especially after what we're seeing recently with the Fed response to this global contagion.
And I want to talk about that in a minute, but I first want to get your thoughts on just the mining sector in general, because I know a lot of people are, saying that, well, there's a few things that you can do to protect yourself in the coming economic crisis, and that's have some gold, have some silver, have some nice arable, have some farmland or something like that. A lot of people also say, buy the miners because that's going to give you so much more leverage. But I'm thinking about the miners and I'm just thinking about several issues. One of the issues I'm thinking about is possibility of nationalization. Another thing that I'm thinking about is like conflict mine. There was a story last week in the news kind of about how the Perth Mint has possibly been purchasing conflict mine gold. And then there's also issues like earthquakes. Just this morning, we got a text message from family down in Mexico. They had a 7.1 on the Richter scale earthquake in Mexico City, I think. The details are just coming out. It's breaking. I haven't even looked into it yet, but they texted us and said, oh my goodness, they just felt the building shaking. So to me, my point with drawing all this out is it seems like there's a lot of risk in the mines, plus it's in that paper financial market paradigm. So just what are your thoughts on the mining sector in general, and what are your thoughts on wealth preservation and real, physical assets, whether it's farmland or gold or silver, versus just in being in the financial sector in general, if that made sense, Steve?
No, it did. And I see it in two ways. There, there are a lot of analysts who do promote getting the leverage in the miners, and that's fine. And so, yes, we could see it doesn't matter if there's so many junk mining stocks. I hate to say it, and they're being peddled all up and down the internet, and a lot of people are losing money on these junk stocks. They're never going to become mines, but you know what might happen when things start going crazy? If the name silver is anywhere in this mining company, you could see an explosion in the price. But that's not something to bet your money on. So the second thing is this. It depends on how much money or funds that you have. If you have a smaller amount of funds, it's common sense to me that you're more conservative. And if you're going to protect your wealth, it's mostly in physical metals. If you want to play in the paper market or you want to get leverage, then you take a small amount that you can lose in the miners. Now, if you're a wealthier individual and you've got everything covered, you've got some people working on your big farm, they produce your food for you, you've got a lot of money, well then if you want to invest a lot more in the miners and get the leverage and you can lose that money, well then I can see that. That makes sense to me. But most people, they need their funds. So it only makes sense to me, Paul, that it's the wisest thing to do is to hold your wealth in real physical assets. And if you want to speculate because you just have to, you put a very small percentage in that. And then if you lose it, it's not a problem for you. But if you are betting everything on leverage, that's very unwise, especially today in these paper financial markets. Because if they shut down, how are you going to get your funds out of there?
Mm-hmm, mm-hmm. Exactly. Those
and
are
it's
all...
like, yes. And so if the market shuts down or the prices change drastically that you can't even make your trade, that's something you have to consider.
Mm-hmm, mm-hmm. Very interesting points there. Thank you for answering that question, because that's a very controversial topic, one way or another. Now, Steve, if we could just talk about kind of like how you see things playing out here. I know before we started recording, you had mentioned that the rig count is down like 70 some percent for the U.S. oil industry. So just how do you see, now we have civil unrest, we have protests, we have riots, we have lockdowns, we have supposed reopening, but now it seems like possible lockdowns again. So with all of these dynamics that have just been changing so fast here in 2020, Steve, just what are you kind of looking for over the next like 6 months and over the next year? And how do you think that economy is going to play out? And could you talk to us a little bit more about precious metals religion? Because I know that that's a term that you came up with, but I think it's very apt to what could be coming down the pike. Could you have some comments on that, Steve?
Sure. Let me give you an example before I start. There are the largest oil fields or regions in the world. There's Saudi Arabia's Ghawar field. They discovered that in the 40s, and that's the largest oil field in the world. It was producing like 5 million barrels a day. As of last count, it was producing 3.8 million barrels a day in 2018. The other largest is the Permian region in Texas. That produced 3.5 million barrels of oil a day in 2018. Here's the difference. The Ghawar field is depleting about 5 to 6% a year. It's about 175,000 barrels a day. It's losing a year. The Permian is losing half of its production every year, 50%. So what does that mean? All the companies in Texas and Mexico, that's where the Permian is located, they got to go in there and they got to drill thousands of new wells just to maintain or grow production. And they've been doing that. But when you compare a 50% annual decline rate to a 5 or 6%, it doesn't take a brain surgeon to figure out the first one isn't sustainable. And that's where the problem is. And right now, the Permian, because the drilling rig count has fallen 76%. Let me tell you, a year ago, there was 789 drilling rigs in the U.S., mostly oil, drilling for new wells. It's down to 189. It's 600 less. All shale is, it depends on drilling rigs and new wells. That's where the production is. And so when you've taken off 76% of the drilling rigs, that means you got a collapse of oil production coming. Mm-hmm. And the shale oil industry was so weak to begin with. This is going to be the final nail in the coffin. And so when you add all this up, it's really going to hurt the U.S. economy. Even though we can import oil, Paul, it's going to hurt the U.S. economy severely.
And because I'm adding it all up in my head, and it's just making me think, well, there goes, the oranges from California sent all the way to Connecticut, right? It'll be the Florida oranges or nothing. And, it's going to be the tobacco in North Carolina is going to be sent to Virginia, and it's not going to be sent halfway around the world. Like these are the kind of dynamics that I'm thinking about when I'm adding it all up. I'm thinking about kind of like just the United States and the world for that matter, just reverting way more local as opposed to more globalized. Is that a way to think about it, Steve?
Yes, and the reason why is when you look at a graph, graphs tend to be symmetrical. And from the 1930s, after the Depression, people say, well, how did the U.S. get out of the Depression? It was World War II. No, it wasn't. It was the oil. The United States was Saudi Arabia during the 1930s and 40s. We supplied all the oil to the Allies. It was the oil that won that. And because Germany didn't have the oil, they lost the war. Same with Japan. I saw a very interesting statistic. The Japanese soldier had about 4 pounds worth of supplies for each soldier. The U.S. soldier had over 100 pounds. It was a battle of resources. That basically is what it was. And so when you look at the chart of U.S. oil production since 1930 to 1970, that was conventional. It looked like it went 45 degrees, and then it started to decline at 45 degrees. You look at shale oil production in the U.S., it looks like a rocket ship went off. It's gone up exponentially. What goes up exponentially comes down exponentially. So we're going to see a collapse in oil. And what that means, you're correct. The world is going to become a bigger place again. Globalism is going to go the other way. It's going to become more local and all these things. And so there's a lot of problems with that. But the biggest problem comes with all the debt, the derivatives, all the fiat money, and all the stocks and bonds. Their value isn't worth it. And so that's when we come to the precious metal religion. Right now, most Americans believe in the energy tooth fairy is going to supply all this energy forever, which gives a value to all stocks, bonds, real estate, and pension plans and all that. But when that energy becomes problematic, all those values start to collapse. And this is going to be the aha moment. I call it the next transition we're heading towards. We're going from building wealth to protecting it. Mm-hmm. And that's going to be a major transition that unfortunately most people are not going to be able to transition to.
And if I could play devil's advocate here for 1 minute, Steve, but what about Alaska? Can't there's just all this untapped oil in Alaska? That's one. And then two, what about alternative energy? Can't we just save ourselves with wind and solar? So how do you respond to those two questions there, Steve?
Well, it depends how you look at the information. I know the gentleman, Lindsey Williams, he was the preacher that supposedly was up in Alaska, and the wealth, they said there was all these billions of barrels of all this oil, and there just isn't. And the biggest rig, that was called the Liberty rig, they were trying to drill this huge 5-mile long horizontal well to get to the oil field. And Lindsey Williams had said it was the biggest oil rig in the world to tap into the biggest oil field. No, that's pure nonsense, because the huge oil fields that we tapped into in the United States and even in Saudi Arabia were typical small drilling wells. They weren't big, but you need such a huge drilling well to be able to have the technology to drill a horizontal well 5 miles. And the amount of oil there wasn't really all that much. And Alaskan oil production continues to decline. So no, there really isn't the oil there. Believe me, if the oil was there, we would have tapped into it. It's just not there. And so the other aspect is, what about alternatives? Well, if anybody can come up with a way to produce a wind turbine, solar, geothermal, all the equipment, all the manufacturing parts to make those energy units without using any oil, natural gas, or coal, then I would say you can do that. But all those things are only possible with oil, natural gas, and coal.
And then one more follow-up devil's advocate question, because this is really fascinating, because it also makes me think of kind of like the debt in the same sense where, well, we'll worry about this energy problem when we get to it. But, there's going to come a point where you have to deal with it now because things are going to abruptly change. So it seems like there's a lot of can kicking, and same thing with the debt. Do you have any thoughts to add on to that, Steve?
Yes, and before we wrap up this, I do want to talk one last thing about the manipulation of the precious metals. I want to clarify my position on that. But yes, the debt right now is being used to offset this falling energy return on investment. Because we can't, the energy quality is falling, we can't afford the same amount, we add more debt, and the interest rate has to fall. So when they say, well, we'll just have a debt jubilee, we'll start over, or we'll have a gold reset. And there's a lot of analysts, Jim Rickards and all these different precious metal analysts and financial analysts say, we'll just have a new gold reset, even Peter Schiff, and we'll start over and have another booming economy. You can't shove a gold bar in a gas tank. The gold bar and coin will still protect your wealth. It doesn't change the energy dynamic. The energy dynamic will still continue to deteriorate. That is going to happen. That's a guarantee. The problem with the debt, once it starts to implode, Paul, it's going to take all the asset values down with it. Mm-hmm. And so that's the major issue that people don't understand. The debt is propping up the system, propping up the assets. Let's say the highly leveraged assets that you should not be investing in.
Mm-hmm. And so let's transition to this last topic here, Steve, with the manipulation. I'd like to say one of the things that I think about a lot is, you hear it all as far as, gold and silver are hedges against uncertainty. Gold and silver are wealth preservation. Gold and silver is a bet against monetary debasement and central bank and government fiscal and monetary policies. It's an insurance. It's a hedge against inflation. But when I think about the manipulation, and especially silver, if silver has been actively suppressed in price, and I believe that it has, then in addition to all of those things that I just mentioned, then there's also going to be a reversion to the mean, which means massive substantial capital gains in and of themselves just to make up for the decades of price suppression policy. So that's kind of my point of view and my way. And, I've asked Paul Craig Roberts on the show before, is gold and silver suppressed by an active policy? And he said yes. And he explained some of the ways that they do that. He's an assistant secretary Treasury to the United States under Reagan. So I'll let you take it from here, wherever you want to talk about, however you want to talk about the manipulation, Steve.
Paul, well, I agree with you. There is going to be a rebalancing, but it's based upon the metals as money, not commodities. And currently, well, let's say in the past decades, the metals have their value is based as commodities. What it costs to produce them and supply and demand. Everything that's being sold in the market has a cost of production. Let's say goods. I'm not talking about land, raw land or whatever. I'm talking about manufactured goods, which is basically our economy. The price that's being sold at is based upon its cost of production. Then supply and demand, all that does is pull or above or below that cost of production. That's what's been happening with silver. Now, silver as a commodity, I don't see it being manipulated, because right now it's $18. The mining industry, they cost them $15. They're making money. The gold mining industry is actually doing really well. It costs $1,200 to produce an ounce of gold. They're getting almost $1,800. They're making serious margins as a commodity, and this is how it's being traded in the economy. That's how the world is viewing gold and silver, not as money, but as commodities. Gold is getting a much better bid because it's moving more towards money. Silver hasn't got that bid yet. Where the metals are being manipulated as the store of value, store of energy equivalent value as money. All energy equals money. That's all it does. Labor, oil, whatever it is, energy equals money. As I mentioned, the economy is nothing but trading energy. The transition is going to be when the world finally realizes, they get precious metal religion, that most of the assets they own don't store value. They don't store energy equivalent value. They're energy IOUs. You got to burn more energy in the future to provide that stock price its value. That's the big difference between the metals. And so there's two things happening. The metals are being traded more as commodities. They're going to transition to money. And yes, there could be the government in there. There could be slamming the metals. But everything's being manipulated. Everything is being manipulated. With the Fed buying all these different assets, that's manipulation. Everything is manipulated. So yes, there is, if the silver price on the market was $5 an ounce and it cost 15, I would say there's blatant manipulation of silver because the mining industry would fall apart. But if we look at the value of most goods in the market, Paul, they're based upon their cost of production. And right now, it costs $15 to produce silver. It costs $1,200 to produce gold. And that's where they're keeping it. They're capping it there as best they can. And so I think as the world wakes up to this energy problem, and that to me is the most important thing to focus on, is the energy. When the energy becomes really problematic, all those $400+ trillion of assets of stocks, bonds, and real estate are going to lose value, and the metals are going to transition, just like you said. They're going to make up for lost time because it's going to come down to real supply and demand.
And last question here, Steve. I don't think that anybody was expecting 2020 to turn out like it has. My wife and I just are amazed that we're already halfway through the year and just so much has changed this year in and of itself. So just the question is, what are some of the things, because everybody's looking at this different, is this a hoax? Is this not a hoax? Are we going to have a V-shaped recovery? Are we going to have an L-shaped recovery? So I guess my question is, what is on your radar right now the most, Steve, other than energy? What is on your radar right now, and what are you going to be looking at as we move through the summer and into the fall in the economy, on Main Street, or in the markets? However you'd like to take that question.
Sure. I would say the first is always energy. It used to be the precious metals and then energy, because without energy, we don't do anything. But the second thing I'm looking at is the economic fundamental dynamics. Now, I don't care if this was a big elite conspiracy, and even if people say it is, and it's a big money grab, this is another way for the elite to take over more assets of the world. I don't agree, because when energy becomes problematic and they own all this real estate or they own all these businesses, they're going to be in really big trouble. So if they're owning more of this stuff, they're going to be in even bigger trouble, because all that is going to become in serious trouble, because we won't have the energy to run all that stuff. So yes, back in the 1930s and all these recessions, if people want to say, well, the elite just got more control, the elite are going to lose a lot of control. Because I'm not saying the elite are going to lose all the control in the world, because the elite have always been in control throughout history. That's not changed. But a large percentage of elite are going to get wiped out, totally wiped out. So to me, I look at the economic indicators, how they're changing, regardless if this was some kind of conspiracy or just people reacting. politicians reacting. It doesn't matter. Either side of the equation, I could care less. But what it's doing, it's causing real havoc in the economies. And so I look at that, and I think it's going to get much worse. I think we're going to see this global contagion get even worse in the second half of the year. We could see more shutdowns, and that is just going to be another nail in this whole energy coffin. And so I think the world, we're not going to recognize it in 10 years. Honestly, I say U.S. oil production is going to collapse by 75% in 10 years. And then a lot of production is going to come off in the rest of the world. And what does that look like? What does Dallas and Fort Worth look like when you're only using 25% energy? You only got 25% of the cars running around. What's that going to do to housing prices, businesses? It's no one sees this coming, Paul. Very few people do. So that's what I'm looking at.
And Steve, you don't charge for any of the articles that you put out, and you put out wonderfully detailed articles with awesome custom charts that you create, and you do all of that stuff. So what do you want people to get out of srsroccoreport.com, Steve?
To me, I would say if you everybody is very specialized. The precious metal guys don't care about energy. The energy guys that really understand the energy situation, they don't care about precious metals. They're holding on to their 401ks, and I'm thinking, you understand the energy? Why are you holding on to your paper asset? And then the finance guys are the worst. They don't care about the energy or the precious metals. So to me, I think if you understand the energy, you'll know you won't you won't flip flop. Like a lot of people complain about the gold and silver price, so they complain the manipulation is going to go on forever. No, it's not. If you understand what's happening with the energy, even though it's boring, you will understand why it's so important to hold on to the precious metals. And I think that's probably the key that I try to get across to people. And the more wealthy people understand this, the more people start to wake up. Paul, it won't you take 1% of the population, 0.5% moving the metals, it's a total different game. It's, we had a big spike in silver buying and gold, especially silver. We ran out a lot of silver bullion products, right, in March and April. But that's still that's still mostly the precious metal guys. And there's been a lot of new people buying. Wait till you get 1% more. That's a whole different game. So I think that's where I focus on, is getting people to really understand the energy. Make it a focus, because I tell you, a lot of these very smart precious metal guys and financial guys, they want to remain oblivious. They want to stick with their specialization, and they don't want to look at energy. It amazes me. So that's why I focus on the energy.
Steve St. Angelo, I'd like to thank you for joining us again on Silver Doctors.
Thank you very much for inviting me, Paul.